In this video, I'm gonna walk you through how wealthy people build tax-free income streams in retirement. Not the watered down version you find everywhere else. The real strategies that high net worth people are actually using. The ones that let them pull hundreds of thousands of dollars out of retirement and pay little to nothing in taxes. And here's the thing most people never realize. The wealthy aren't doing anything illegal. They're not hiding money offshore. They're just using the tax code exactly how it was written. And once you understand how these strategies actually work, you're gonna look at your retirement plan completely different. By the end of this video, you will know what these strategies are and how to build tax-free income that the IRS approves of. I first wanna highlight why tax-free income changes everything. Here's the thing that most people don't understand about retirement taxes. During your working years, your income is pretty predictable. You know what you make, you know what you owe, you plan around it. But in retirement, taxes become a completely different animal because now every dollar you pull hits your income. And your income determines your tax bracket, your Medicare premiums, how much of your Social Security gets taxed, and a whole list of other things that most people don't see coming. Here's a real number to make this concrete. In 2026, if your income crosses certain thresholds, Medicare charges you what is called an IRMAA surcharge. Just in case you don't know what IRMAA stands for, it stands for Income Related Monthly Adjustment Amount. A single retiree at the highest income tier pays an extra $6,936 a year, just in Medicare surcharges alone. A married couple pays nearly $14,000 extra a year, on top of everything else. Here's the kicker. That surcharge is based on your income from 2 years ago. So the decisions you're making right now are already determining what you'll pay for Medicare in 2028. Most people have no idea that this is even happening. Wealthy people figure out goal is to not just save money. The goal is to build income streams that the IRS cannot tax. Income that doesn't count towards your taxable income. Income that doesn't push up your Medicare costs. Income that doesn't increase your taxes on your Social Security. That's the game. And most people aren't even playing it. Let's talk about how you build these income streams. Now you know why tax-free income changes everything. Let's get into the practicalities of how to actually do it. Number one, the Roth strategy, the most powerful tax-free tool. There are a lot of ways to use the Roth strategy. Most people actually phase out of being able to contribute to a traditional Roth IRA. Single filers actually phase out of making over $168,000. Married couples phase out when they make over $252,000 a year. So a lot of people who have a very good income think they can't contribute to a Roth IRA, which is false. You actually can. You can do what's called a backdoor Roth. As long as you don't have money in a traditional IRA, you can actually use after-tax funds that can go into a traditional IRA and then convert over to a Roth. There is no income on the conversion limit. So you can actually do that for quite some time. So if you're in that age where you're still trying to accumulate for retirement, it's a fantastic strategy to start utilizing. Another way is actually in retirement plans or 401ks. A lot of 401ks allow you to actually put away money as your employer contribution as a Roth, which can be extremely powerful because it's probably the largest tool that you can use to put that much money into a Roth. We're talking over probably $24,000 that you can put away into a Roth IRA. In a 401k, you can actually put away quite a bit of money. For those of you under 50, you can put away $24,500. For those over 50, you actually can put away $32,500. And don't forget those people who are between 60 and 63 actually get the super catch-up, which actually would bring it to $35,500. So it can be an extremely powerful tool. Also, the new rule actually states that if you are in a high income tax bracket, your catch-ups actually are going to have to go into the Roth anyways, so might as well look to actually put the whole amount in so you can get that tax-free growth throughout retirement as well and not be subject to required minimum distributions upon retirement. So again, 401k, really good tool to actually utilize and be able to put quite a bit of money into a Roth, even if you have a high income. Now, the third option that you can actually look into is doing Roth conversions. Now, where these really make sense is going to be between the years of when you fully retire and when you have required minimum distributions kick in at 73. Those years, you typically are going to have one of your lowest tax years or taxable income years. And a Roth conversion can make a lot of sense. Again, you want to look at it year to year because everything does change as those years go by. So these can be some of your lowest income years in your almost entire life prior to you actually working. So it can be extremely important to look at when those years happen to roll over money because there is no income limit. And one of the big strategies that you could use is what's called filling the bracket, right? And so what you do is you look at what bracket you're actually hitting in regards to your taxes with your income in that year. And you say, okay, let me fill the bracket. How much money can I put into a Roth conversion and stay within the tax bracket that I'm currently in hope that you actually pay a lower amount in that conversion than you would if you finally get subject to required minimum distributions after the age of 73. So again, Roth is a very powerful tool. It does grow tax-free. It isn't subject to required minimum distributions and can be inherited to kids and have a very favorable tax for them as well because it won't be taxable for 10 years once they inherit it as well. Strategy number 2, the IRMAA trap and the triple tax-free weapon. IRMAA, in plain English, is the surcharge that Medicare places on your Part B and Part D Medicare premiums. And that's when your income crosses a certain threshold. In 2026, those thresholds start at $109,000 for a single filer and $218,000 for a married couple. Cross that line by $1 and your Medicare Part B premium jumps up from $202.90 to a significant higher amount per month. And the more your income goes up, the more that premium goes up. And at the highest tier, single filer pays $689.90 per month for the same coverage that costs everyone else $202. That is nearly a $14,000 year difference per person. Now here's the trap that gets most wealthy people. They think they're being smart by holding municipal bonds to avoid income tax. A municipal bond is federally tax exempt, but here's what most people do not know. For IRMAA purposes, municipal bond interest gets added back to your MAG. If you don't know what MAG stands for, it's Modified Adjusted Gross Income. So with that, you're getting 0 federal income tax benefits. So you're getting the benefit of not having to pay federal taxes on that interest of the municipal bond, but you're getting hit still with having to pay the additional premium on your Medicare surcharge. So this is the municipal bond trap that catches a lot of sophisticated investors off guard, meaning your 2026 Medicare premiums are based on your 2024 income. By the time you get the surcharge notice, the income that triggered it is already in the past, which means it's very difficult to change. So what do? You build income sources that are completely invisible to IRMAA, qualified Roth withdrawals, 0 IRMAA impact, 0 federal tax, HSA withdrawals for qualified medical expenses, and we'll be getting to that soon. These are some of the tools that wealthy people and their advisors use to help pull money in retirement without triggering any of the downstream consequences that can come with taxable income. So if you're ready to review your current situation and figure out a way to optimize your taxes for your future retirement, there's a link for you below. Book a call with me, and I would love to sit down with you and have an honest conversation. I'll see you there. All right, strategy number 3, the HSA triple tax-free. HSA stands for Health Savings Account. What a health savings account is a very powerful tool tied to high deductible medical plans. What it is the amount that you can put away and you can actually use for medical expenses. But it goes in triple tax-free, meaning the money you put into it, you don't pay taxes on it. It can be invested so it grows and you don't pay taxes on that. And when you take it out for qualified medical expenses, you don't pay taxes on that either. Why is this a very important tool is because the money never expires. Different than an FSA or flexible spending account that expires at the end of each year, an HSA does not expire. So you can actually have that money in there, have it invested, and have it grow, and then you can utilize those funds in retirement for things that aren't covered by Medicare. One of the biggest ones being dental expenses, which can be a very big hurdle in retirement as far as having to cover those expenses. So building up kind of a war chest in your HSA while you're still working can be an extremely powerful tool before you hit Medicare age. Strategy number 4, cash value life insurance and tax-free income with no IRMAA. Cash value life insurance can be used for tax-free income. On this one though, there are a lot of complicated factors. So it's one of the things I say last when we're talking with wealthy individuals because I think the prior options I've given have to be utilized to the max before we get into this one. But how this works is you can actually put away money into a life insurance policy, whole life, IUL, or index universal life, and it can grow value into it. That value can actually borrow against, and that borrowing that you're borrowing on that life insurance policy is considered a loan. So there is no income that is actually being emitted even though you're being able to utilize those funds. So it can be a very powerful tool, but because there's so many moving parts within an insurance policy, I do say make sure you go in with your eyes wide open. This isn't a cure-all, and there definitely are some moving parts that you need to be aware of to make sure you don't mess this up when you are actually taking those withdrawals or loans, I should say, against your policy. Lastly, strategy number 5, QCD. Stands for Qualified Charitable Distribution. What that means is it's money that you're taking out of your IRA and you're giving to a qualified charity. So this can be a powerful strategy if you're charitably inclined, because at the age of 70 and a half, you're actually able to take out $100,000 per year and give to a qualified charity. This can be a meaningful amount of lowering your IRAs, 401ks that you might have, or tax deferred accounts that are quite large and could be subject to a required minimum distribution, or RMDs, at the age of 73 later on. So as we get into those requirement or retirement years, what you can do is anything that you are giving to charity, doesn't matter what kind of charity, as long as it is a qualified charity, is you can give from your IRA. And I always suggest clients actually give from their IRA in those years to satisfy this, because it's lowering the amount they have to take from their required minimum distribution, because that QCD that they give counts towards the RMD. It can be an extremely powerful tool because you aren't paying taxes on the money you give to charity. So again, that can actually be money that you never paid taxes on because you didn't pay taxes on it when it went in, it grew tax deferred, and when it came out and went to charity, it also wasn't subject to taxes. So it also can be something that most wealthy people who are charitably inclined use quite a bit in retirement. Look, everything we talked about today is completely legal. Every single strategy is IRS approved and has been used by wealthy families for decades. The difference between someone who pays a massive tax bill in retirement and someone who pays almost nothing is not how much they saved. It is whether they understood these strategies that I talked about in this video and built their plan around them before it was too late. The 5 strategies that we covered: Roth accounts and the backdoor Roth, managing and avoiding the IRMAA trap, the HSA as a triple tax-free weapon, cash-free life insurance as a tax-free income bucket, and qualified charitable distributions to eliminate taxes on required minimum distributions. These are not theories. These are strategies we build into real retirement plans for real people like you here at Bonfire every single day. I did it yesterday. And here's the honest truth. Most of these strategies require planning ahead. The window to a Roth conversion typically closes when RMDs start. The window for an HSA closes when you enroll in Medicare. And the window to structure a cash value policy correctly closes when you wait too long. And the cost of insurance makes it inefficient. These are not things that you figure out the year you retire. They are things you build towards. If you're ready to build a plan about actually keeping more of what you worked your whole life to earn, click that link in the description and book a call with me. It's completely free, and I promise you, you will not regret it. I'll see you there.